Hi all. Today we are going to see about types of loans which are given by banks to individuals as well as corporates. There are two types of loans. Basically, loans are categorized into two types. They are secured loans and unsecured loans. Secured loans are basically backed up by an asset, which they call as collateral security. And based on that collateral securities, bank give a loan. Usually, these loans will be higher in amount and will be for a longer period. So the uh, interest rates will be comparatively low when compared to unsecured loans. In unsecured loans, the loans will be much less compared to secured loans, and the interest rates will be high, of course, because they give loans based on your credit rating. Usually it should be 750 or more. So if it is less than 750, banks or financial institution won't consider it for giving loans. Or if it is less than 750, they will charge comparatively higher interest rate because of the risk involved. And it will be for a minimum period, which is usually less than 12 months when compared to secured loans. These loans can be categorized further into two types. First one is loans given to individuals, and second one is loans given to business. First, we will see about loans which are the loans given to individuals. In that, first we will see what are the loans given for which are the loans given for individuals which are secured. First, retail or personal loans. In this type, first one, housing loan. Housing loan is basically for constructing or purchasing a house. If you see income tax also, there we will come across under the head capital gains. We will see about housing loans. Housing loan will be usually for around 20 to 30 years, and it will be much less interest rate because it is charged for 20 to 30 years. And the collateral security involved here is the construction which is being constructed or the flat which is being purchased. These properties will be kept as a mortgage against your loan. Second, vehicle or auto loans. These loans will be usually for 3 to 7 years, and with this interest rates will be high when compared to home loans because the tenure is comparatively low. So, and the security involved here is the vehicle being purchased. Here the term used for the security is called hypothecation. The difference between mortgage and hypothecation is mortgage is usually used for term used for immovable assets, and hypothecation which is used for movable assets. And one more difference is in hypothecation, if you don't pay loan, then actually here the assumption or the agreement is that if you don't actually you are getting loan, but the building will be but the vehicle will be in the name of the financier or bank's name. Until you pay the loan completely, it will be in the name of bank or financial institution. If you are not if you could not pay the loan, they will seize your motor vehicles. In case of immovable property, in case of home loans, the procedure is same. The immovable property will be in the name of the financial institution or bank. If you didn't pay, if you could not pay the loan, then they will acquire the immovable property. The just difference is that the security being involved and its nature. Third, gold loans. Here we used the term called pledge. Concept is same, such as mortgages, such as like mortgage or hypothecation. Concept is same. Pledge, in the pledge also we keep the loan is given against the jewelry, and this loan will be also for will span up to 1 to 3 years, and the amount given is usually 75% or 90% of the market value of the gold involved, and interest rates will be high. Unless and until you pay the gold will be held with the bank. If you could not pay the loan, then the gold will be sold by the bank in order to recover its proceeds. Fourth, loan against property. Again, it is similar to home or housing loans, but the concept involved here is this loan is kind of loan which usually loan taken against existing construction or loans or immovable properties. Generally people used to keep their building or their own flats under mortgage in order to acquire loans for their marriage purposes, etc., for their son or daughters. So this loan will also mortgage loan will also have similar low interest values compared to housing loan. Next, loan against security. Here generally we if you could log in your net banking, you can see if you have any FD, you can see the term like loan against FD. This is that instead of going for other loans, if you have FD or mutual funds, you can keep them as a security. Instead of keeping any other things, you can keep them as security and get 90% of the FD value as loan, and this loan is renewable. Next, we are going to see about unsecured loans given to individuals. First, in this there are three categories of loan. On that first category is personal loans. On that we are going to see medical emergency loans. Medical emergency loans are taken for any medical emergencies involved. Like that, these loans are will be charged high interest rates due to the risk the banks or financial institutions are taking. Without any security, they are giving loan, so the interest rates will be high. Medical emergency loan are given for medical emergency purposes. Wedding or celebration loans. These loans are specially designed to solve the purpose in order to fund for wedding or any function purposes. Third, travel or holiday loans. If you need to plan any holiday or go to any vacation sites, you can use this loans. Fourth, home renovation loans. Unlike mortgage loan, you have any renovation works in home, you instead of keeping your house mortgage, you can go for home renovation loans. Second type of unsecured loan is education loan. This loan is very popular among students. Usually students will be given loan based on their marks, their scoring pattern. Generally more attentive students or more academically brilliant students will get this loan. This loan is for those who could not afford or could not need to bridge the gap of education by funding their fees. These loans are given to students, and they can usually these loans are given when the students are in college, so that there is a term called moratorium period. This moratorium period means for this period there will be no interest charged. Generally this will be the academic year of students. Means that if you go for college 3 or 4 years, then once you study, once you completed your graduation, go to a job and settle in job. Until that time you won't get any interest, you won't get attracted of any interest. This loan is this time is called moratorium period. After this you need to settle the loan obligation by paying from your salaries. Second, consumer durable loans. Generally we used to call no cost EMI. Whenever we go to purchase any appliance like home, for home like TV, washing machine, mobiles or anything like that, these loans will be very popular among that, and there will be readily 2 to 3 financials will be available there. In every appliance store you can go. These loans are charged against the products you actually buy, and they used to tell us no cost EMI. Actually the EMI is involved, but the thing is in the EMI itself they will charge interest and principal, and but the EMI amount will be same. So the interest and principal portions will be varying, but the EMI will be same. But people used to call it as no cost EMI in order to attract people for purchase. Next, this we are going to see commercial or business loans. In that, first, working capital loans. We will see 2 loans, 3 types of loans actually together, so that you will get to know the difference between them, because they are actually interpreted as one and same, but they are slightly different. We will see how. First, working capital loans. Working capital loans are taken for day-to-day operations. These loans are given against current assets like your stock, like that they will give working capital loans. Next, business overdraft. Business overdraft is the generally business like by individuals having savings account, business will have current account. The business overdraft is that there will be a credit limit, which means that even below your current account balance, that it can go up to negative balance, but there will be a certain limit, so that you can get a loan against it acts as a loan. So below your current balance, current account balance also, you can draw up to a certain limit. Cash credit. This is also similar to bank overdraft. In your current account, you can draw up to certain pre-sanctioned amount. The difference between, let's see the difference between 3 of them and the usage of 3 of them. Working capital loans. These are very basic loans which are given to people. Like the loan will be disbursed in entirety, and you have to repay them monthly. and these loans will be against your current assets, which acts as a collateral security. In bank overdraft or cash credit, the drawing amount, which you draw over and above your current account balance, will be treated as a loan, and the interest rates in working capital is uh, similar to normal loans, which is against your loan static loan, which will be same, and you will pay the same interest rate for every month, regardless of whether you use the amount or not. The bank doesn't concern whether you use it or not. You should pay interest and principal every month and settle the working capital loans completely. In the bank overdraft or cash credit, you can draw up to a certain pre-approved limit, which will be based on your collateral security and paying ability. Bank will change this overdraft limit on basis of your repayment schedule, your collateral security value, like that. So they will continue to monitor your business performance. In that, you can the withdrawn amount, which is over and above your current account balance, acts as a credit limit, and whenever you settle the obligation in full, then the amount will be on interest. Interest will not be charged on that. Only the period from which you draw until the period which you settle, the interest will be charged against the outstanding amount of that period. The main difference between CC and OD, cash credit and overdraft, is that they are interpreted as one and same. Mostly people will call CCOD, but CC is against stock. Bank overdraft is against FDs, like that, fixed deposits, like that. Here the stock value may change month on month basis. Generally, it is suitable for manufacturers, traders, like that. But not. But every business can obtain bank overdraft, which will be generally the pre-approved limits will be static. Here the CC limits will differ based on your performance or sales, like that. Your stock limits, it will change. So compared to BOCC is more it is more dynamic when compared to bank overdraft. Next, term loans. Term loans are like fixed loans, which is for a period, longer period, generally to purchase a fixed asset or big machineries, or to upgrade your software, or in case where a huge amount is required in order to incorporate a asset or any machineries, or in order to develop a business in high. Whereas CCOD or working capital loans are for day-to-day business, running business. Fourth, lease rental discounting. Here, if a company owns any kind of immovable property, then company can go for this option, which is lease rental discounting, which means that if a company have property and it is renting out to any other corporate, then the loan can be obtained against that immovable property which is given to the tenant. In other words, the corporate tenant. The monthly rent paid by them will act as a guarantee. Next, professional loans. This is especially for professionals like doctors, lawyers, chartered accountants, in order to develop their business. Have a nice day, and we will see in another video. Thank you.